$261 million in assets wiped out overnight, locked doors, frozen accounts, and a single sheet of paper taped to the glass telling depositors that their bank no longer exists. On January 30th, 2026, Illinois regulators shut down Metropolitan Capital Bank and Trust of Chicago, and the Federal Deposit Insurance Corporation stepped in to pick up the pieces, estimating a $19.7 million hit to the Deposit Insurance Fund. That single closure is not a headline. It is a loaded gun aimed at the heart of the American banking system, and the trigger mechanism is a $1.5 trillion wall of commercial real estate debt maturing this year and next that most people have never heard of. For the second year in a row, Chicago produced America's first bank failure of the year, and what mainstream media is calling an isolated event has officially moved from theory to reality. The FDIC's own data shows 59 institutions sitting on its confidential problem bank list, but what they stopped telling you in early 2025 is how much in total assets those banks hold, because the number was so alarming that simply disclosing it could trigger the very bank runs they are trying to prevent. If you thought one small community bank going under was bad, you are not ready for what comes next. The banking system is sitting on $337 billion in unrealized bond losses as of the third quarter of 2025, the 14th consecutive quarter of paper losses, a streak that matches the darkest period of the 2008 financial crisis. Meanwhile, the national debt has exploded past $38.5 trillion. The federal government is now paying over $1 trillion per year just in interest on that debt. And the commercial real estate market is staring down the largest refinancing cliff in modern history. This is not about one bank in Chicago. This is about the architecture of the entire system, beginning to crack under pressure that it was never designed to withstand. Before we go any further, if you are watching this channel for the first time, hit subscribe right now and turn on notifications because the information in this video could fundamentally change how you protect your wealth over the next 12 months. Drop a comment below. One word only. Safe or scared. Tell me how you feel about your money in the banking system right now, and let us get into exactly why this situation is far more dangerous than anyone on cable news is willing to admit. To understand the magnitude of this threat, we have to look at a number that almost nobody in mainstream financial media is discussing. The headline figure most people see is that there has been one bank failure in 2026 so far. One. That sounds manageable. That sounds contained. But the real number, the one that should keep you awake at night, is the $875 billion in commercial real estate mortgages scheduled to mature in 2026 alone, according to Reed Smith's analysis of $5 trillion in outstanding commercial mortgage debt. Most analysts ignore this. What they are not showing you is that over $600 billion of commercial real estate loans that were supposed to mature in 2025 never actually got resolved. They were pushed forward, extended, modified, papered over with new terms and longer grace periods, in a practice the industry quietly calls extend and pretend. That $600 billion did not disappear. It stacked on top of the 2026 maturities, creating a refinancing tsunami the likes of which this country has never seen. To understand how we got here, you have to go back to the arrangement that powered American banking for decades. It was in many ways the greatest financial arrangement in history. Banks would take in deposits from savers at low interest rates, lend that money out to commercial real estate developers and businesses at higher interest rates, and pocket the spread. The Federal Reserve kept this machine running by maintaining predictable, low interest rates that allowed banks to price risk, make loans, and hold long-dated bonds without fear of catastrophic value loss. Developers would build office towers, shopping centers, and apartment complexes. The economy would grow, tenants would fill the buildings, rents would rise, loans would get repaid, and the cycle would repeat. This symbiotic relationship powered the American economy for generations. Banks made money, developers made money, the government collected taxes. Pension funds earned returns. Everyone won. But as of this month, that arrangement is officially dead. The Federal Reserve hiked rates at the fastest pace in 40 years beginning in 2022. And even though they have cut back down to a range of 3.5 to 3.75%, the damage was already done. The bonds banks bought when rates were near zero are now worth dramatically less than what they paid for them. The office buildings those loans finance now sit 20% vacant, according to Cushman and Wakefield. The developers who need to refinance are discovering that the new loan terms require payments they cannot afford because their buildings are generating half the rental income they projected. The partner has become the adversary, and there is no going back. Here is where the real danger begins. And I need you to pay very close attention because what I'm about to walk you through is a chain of interconnected crises, each one triggering the next, each one escalating the damage, and all of them converging on the same target: your savings, your retirement, and your purchasing power. The first crisis is the commercial real estate maturity wall itself. Over $1.5 trillion in CRE loans will have reached maturity by the end of 2026, according to PB Mayer's analysis of federal data. These are not abstract numbers on a spreadsheet. These are loans attached to real buildings in real cities that must either be refinanced at dramatically higher interest rates or defaulted on. When a developer took out a loan 5 years ago at 3% interest and now has to refinance at 7 or 8%, the math simply does not work when the building is only 60 or 70% occupied. This is why Metropolitan Capital Bank failed. The FDIC's own press release and Biznos reporting confirmed that the first bank failure of 2026 had direct ties to commercial real estate. They know that Metropolitan was not unique. It was simply the first domino in a line of dominoes stretching across the entire regional banking sector. This is why the second crisis emerges from the first. When commercial real estate loans default, the banks holding those loans must recognize the losses on their balance sheets. For small and regional banks, commercial real estate represents a massive concentration of their total loan portfolios. According to data from the Federal Reserve and analysis by Stanford researchers, the actual market value of assets in the U.S. banking system is $2.2 trillion lower than the stated book value. Read that again. The banking system is overstating its assets by $2.2 trillion. A substantial number of institutions are at risk of failing should there be a run by uninsured depositors. This is not a conspiracy theory. This is Stanford University publishing peer-reviewed research saying the banking system's real value is trillions less than what the balance sheets show. This is why the FDIC stopped disclosing the total assets on the problem bank list in February 2025. They know that transparency itself has become a weapon. If depositors saw the true number, the rational response would be to pull their money, which would cause the very crisis the regulators are trying to prevent. This is why the third crisis stacks directly on top. When banks start recognizing commercial real estate losses and their capital ratios deteriorate, they are forced to either raise new capital by selling shares, which dilutes existing shareholders and tanks the stock price, or they must sell assets to shore up their balance sheets. But here is the trap. The assets they would sell are the very bonds that are already sitting at $337 billion in unrealized losses, system-wide. If they sell those bonds, the unrealized losses become realized losses, which further destroys their capital position. This is exactly what happened to Silicon Valley Bank in March 2023. SVB tried to sell its bond portfolio at a loss to raise cash. The market panicked, depositors fled, and within 48 hours the bank was dead. But here is what is terrifying. SVB was one bank with $209 billion in assets. The problem I am describing right now exists across thousands of institutions simultaneously. This is not a repeat of 2023. This is 2023 at a system-wide level. You are paying this premium every single month, whether you realize it or not. Every time your bank offers you a savings rate that is a fraction of what the Federal Reserve charges, that spread is the bank's profit margin. And that margin is being eaten alive by commercial real estate losses, unrealized bond losses, and the rising cost of keeping depositors from fleeing to higher-yielding money market funds. The fourth crisis layer is the doom loop, and this is where the situation becomes truly inescapable. When banks tighten lending because their capital is under stress, they stop making new loans to businesses. When businesses cannot get loans, they cannot expand, they cannot hire, and some of them fail. When businesses fail, their employees lose jobs, Those employees stop paying their mortgages and car loans, and those defaults flow right back onto bank balance sheets as even more losses. Crisis A, the commercial real estate wave, causes Crisis B, bank capital deterioration, which causes Crisis C, a credit crunch on Main Street, which causes Crisis D, rising consumer defaults, which makes Crisis A worse because the economic weakness further depresses commercial real estate values, and vacancy rates rise even higher. This is a negative feedback spiral, a financial whirlpool that gains speed the longer it spins. They know this loop exists. Every central banker, every FDIC official, every Treasury Secretary who has studied the 2008 crisis knows that this is exactly how the Great Financial Crisis metastasized from a subprime housing problem into a global economic catastrophe. But the difference between 2008 and today is that in 2008, the federal government had a debt-to-GDP ratio of about 64% and could borrow trillions to bail out the system. Today, the national debt stands at $38.56 trillion. Debt to GDP is approaching 100%, and the Congressional Budget Office just projected it will hit 120% by 2036. The ammunition that was used to fight the last war is gone. This is why the fifth crisis matters so much. The U.S. government is now spending over $1 trillion per year just on interest payments on the national debt. That number surpasses the entire defense budget. According to the CBO's February 2026 projections, the annual deficit will reach $1.9 trillion this year and balloon to $3.1 trillion by 2036. Interest payments alone are projected to double to $2.14 trillion per year within a decade. This means the government is borrowing money to pay the interest on the money it already borrowed. This is the financial equivalent of using one credit card to make the minimum payment on another credit card. Every dollar spent on interest is a dollar not available for deposit insurance bailouts, emergency lending facilities, or any other tool the government might need to rescue the banking system when the next wave of failures hits. This is coming directly out of your paycheck. Federal tax revenue in fiscal year 2026 stands at $1.78 trillion collected so far, and a growing share of every dollar you send to Washington is being consumed by interest payments on debt that provides you zero services, zero infrastructure, and zero protection. This is exactly what happened to the British Empire in the decades after World War II. Britain's debt-to-GDP ratio soared, interest payments consumed the treasury, the pound sterling lost its status as the world's reserve currency, and the empire collapsed not from invasion, but from insolvency. The same pattern is now playing out in the United States, but on a scale the world has never witnessed. The sixth crisis is the tariff war and its second-order effects on the banking system. The Trump administration's aggressive tariff regime has already added roughly $200 billion in additional costs to American consumers and businesses, according to Brookings analysis. The Tax Foundation estimates these tariffs will reduce U.S. GDP by 0.5% before even accounting for foreign retaliation. For banks, the tariff war creates a pincer movement. On one side, higher import costs squeeze the profit margins of the small and medium-sized businesses that are regional banks' primary borrowers. On the other side, retaliatory tariffs from trading partners reduce export revenues for American manufacturers, farmers, and service providers. When these borrowers start missing loan payments, the losses land directly on the balance sheets of the very same regional banks already drowning in commercial real estate exposure. This is why the tariff war is not separate from the banking crisis. It is an accelerant. It is pouring gasoline on a fire that was already burning. The seventh crisis is the binary trap that the Federal Reserve now finds itself in, and both possible outcomes are devastating for your wallet. If the Fed cuts interest rates further to save the banking system and make refinancing easier, it risks reigniting inflation, which erodes your purchasing power and makes every grocery bill, every rent check, and every tank of gas more expensive. U.S. inflation just came in at 2.4% for January 2026, down from higher readings. But the Fed knows that aggressive rate cuts could reverse that progress overnight, especially with tariffs already pushing costs higher. If the Fed holds rates steady or raises them to fight inflation, the commercial real estate maturity wall becomes even more lethal. Unrealized bond losses grow, and more banks follow Metropolitan Capital into the grave. Either the Fed sacrifices price stability to save the banks, or it sacrifices the banks to maintain price stability. There's no soft landing here. Both options lead to the destruction of your purchasing power, either through inflation or through a credit crisis that contracts the economy and destroys jobs. The Fed minutes released just yesterday showed officials split on where interest rates should go, confirming that even inside the Federal Reserve itself, there is no consensus, no plan, and no clear exit from this trap. The eighth crisis is the deposit flight that is already underway but invisible to most Americans. When Metropolitan Capital failed, the FDIC arranged for First Independence Bank of Detroit to assume its deposits and purchase approximately $251 million of its assets. But what the press releases do not tell you is that across the banking system, depositors have been quietly moving money out of small and regional banks and into the perceived safety of the largest too-big-to-fail institutions and into money market funds that offer higher yields. This migration drains the lifeblood of community banks. When deposits leave, banks have less money to lend. Their funding costs rise as they compete to retain remaining depositors. Their profit margins compress, and their ability to absorb losses from commercial real estate and bonds diminishes further. This is why every bank failure creates the conditions for the next bank failure. It is a siege, a slow suffocation where each institution that falls makes the survivors weaker. Your mortgage payment, your small business line of credit, your community bank's ability to finance the local economy, all of it depends on a deposit base that is actively being hollowed out. The ninth crisis is the one nobody wants to discuss because it implicates the very regulators who are supposed to protect you. The FDIC's Deposit Insurance Fund currently backstops the entire banking system, but the estimated cost of just Metropolitan Capital's failure was $19.7 million. That sounds small, but consider this. The 5 bank failures in 2023 alone, led by Silicon Valley Bank, cost the fund over $548 billion in associated asset exposure. If even a fraction of the 59 banks currently on the problem bank list were to fail in rapid succession, the Deposit Insurance Fund would face a stress test that it has never been designed to survive in its current form. They know this, which is why the FDIC stopped disclosing the total asset figure on the problem bank list. The less you know, the less likely you are to panic. The less you panic, the less likely you are to withdraw your deposits. The less you withdraw, the longer the system holds together. But this strategy only works as long as confidence remains intact, and confidence is the most fragile commodity in finance. It took 48 hours for Silicon Valley Bank to go from functioning institution to federal receivership. It took 72 hours for the contagion to spread to Signature Bank and First Republic. Speed is the Achilles heel of the modern banking system because in the age of mobile banking, a bank run does not require lines around the block. It requires a trending hashtag and a smartphone. The 10th crisis is the one that ties everything together and reveals the true blast zone of this financial detonation. The CBO just projected that U.S. debt will reach $64 trillion within a decade. The annual deficit is approaching $2 trillion. Interest payments are crossing $1 trillion. Commercial real estate has a $1.5 trillion refinancing wall. Banks are sitting on $337 billion in unrealized bond losses. And the economy is absorbing the impact of a global tariff war that is squeezing businesses from every direction. Each of these crises individually would be manageable. Together, they form a compound fracture in the financial system that no single policy tool can fix. This is exactly what happened during the fall of the Roman Empire. It was not one invasion, one plague, or one economic crisis that brought Rome down. It was the convergence of all of them simultaneously, each one weakening the empire's ability to respond to the next, until the entire structure simply could not hold. The United States is not Rome, but the pattern of imperial overextension, unsustainable debt, military spending that exceeds productive investment, and a currency that is slowly losing the trust of the world. These parallels are no longer academic. They are statistical. This means your retirement account, your 401k, your pension, your savings, all of it is denominated in a currency that is being diluted by $2 trillion of new debt every single year and protected by a banking system that is overstating its own value by trillions. Now, let us shift from what is happening to what the smart money is doing about it. Because while most Americans are watching Netflix and hoping the system holds together, the most powerful financial actors on the planet are moving with speed and conviction that should tell you everything you need to know. Gold has surged past $5,000 per ounce in January 2026, a move that Goldman Sachs called the beginning of a structural bull market. Goldman raised its year-end 2026 gold forecast to $5,400. JP Morgan sees gold pushing toward 5,000 by the fourth quarter, with 6,000 as a possibility longer term. But the real signal is not the price. It is who is buying. Central banks around the world purchased approximately 800 tons of gold in 2025 and are projected to continue at that pace through 2026, according to UBP's analysis. China, Poland, India, and a dozen other nations are systematically converting their dollar-denominated reserves into physical gold. They know that the dollar's purchasing power is being eroded by deficits, debt, and monetary expansion. They know that U.S. Treasury bonds, once considered the safest asset on Earth, are now sitting on central bank balance sheets as a depreciating asset in a rising rate environment. They know that the U.S. government's ability to service its own debt without printing more money is mathematically deteriorating with each passing quarter. These are not conspiracy theorists. These are the sovereign wealth funds and central banks that manage the financial destinies of billions of people, and they are all doing the same thing, reducing their exposure to paper dollar assets and increasing their holdings of hard, physical, tangible wealth. This is where you need to examine your own position with brutal honesty. Look at your net worth. How much of it is real and how much of it is paper? Your bank balance is not money you own. It is a claim on money that a bank owes you, and that bank may be sitting on unrealized losses that exceed its capital. Your 401k is not a stack of assets in a vault with your name on it. It is a series of digital entries in a brokerage account that holds claims on stocks, bonds, and funds that are themselves claims on other assets held by other custodians. The distinction between owning an asset and owning a claim on an asset held by a third party is the most important financial concept you will ever learn, and it is the concept that separates the people who survive financial crises from the people who become casualties of them. During the 2008 crisis, millions of Americans discovered that their home equity was an illusion. Their retirement accounts could lose 40% of their value in months, and their bank deposits above the FDIC limit were genuinely at risk. The people who came through that crisis intact were the ones who understood counterparty risk, the risk that the institution standing between you and your wealth might fail. Now consider what is coming. Central bank digital currencies are being developed and tested by dozens of nations. CBDCs would give governments the ability to track, restrict, and even program how you spend your money. Capital controls, which sound like something that only happens in Argentina or Greece, were implemented in Cyprus in 2013 when the government literally froze bank accounts and seized a percentage of deposits above 100,000 euros to bail out the banking system. Negative interest rates, which were once considered impossible, were implemented across Europe and Japan for years, meaning depositors were literally charged money for the privilege of keeping their savings in a bank. Financial repression, the deliberate policy of holding interest rates below the inflation rate so that the real value of government debt shrinks at the expense of savers, is not a future threat. It is current policy. With inflation at 2.4% and savings rates at many banks still below 2%, you are losing purchasing power every single day. You leave your money in a traditional savings account. The window of opportunity to reposition is still open today, but this window will not remain open forever as the crisis accelerates. Every month that passes, every bank that fails, every headline that erodes confidence brings us closer to the point where governments respond not by fixing the underlying problems, but by restricting your ability to move your money. The categories of assets that historically survive currency crises and debt crises are well documented. Hard assets with no counterparty risk. Assets that cannot be printed, diluted, or devalued by government decree. Assets that maintain their purchasing power across generations, regardless of which currency regime is in power. Assets that the world needs regardless of whether the economy is booming or collapsing. Central banks are buying gold at record levels for a reason. Sovereign wealth funds are accumulating commodities for a reason. Billionaires are selling paper financial assets and buying farmland, energy assets, and physical infrastructure for a reason. They are not doing this because they read a scary article. They are doing this because they have access to data and analysis that tells them the current trajectory of the U.S. fiscal situation, the banking system's hidden fragility, and the commercial real estate implosion are converging into a crisis that will reshape wealth distribution for a generation. The question is not whether you agree with their analysis. The question is whether you can afford to bet your family's financial future that they are wrong. This is not just a financial decision. It is a decision about identity. Are you going to be the passive participant who trusts the system to protect them despite every signal that the system is breaking down? Or are you going to be the prepared individual who studies the data, understands the risks, and positions themselves to survive and even thrive on the other side of this crisis? The storm is no longer on the horizon. It is overhead. The rain has started to fall and the old shelter is leaking. Metropolitan Capital Bank was not the first crack in the dam. It was the confirmation that the dam has been cracking for years and the engineers have been quietly patching it with duct tape and press releases while telling you everything is fine. The 59 banks on the FDIC's problem bank list are not fine. The $337 billion in unrealized losses are not fine. The $1.5 trillion commercial real estate refinancing wall is not fine. The $38.5 trillion national debt growing by $8 billion per day is not fine. And the $1 trillion per year in interest payments that are consuming the government's ability to respond to the next crisis are not fine. Build your ark, the flood is not coming, it is here. The water is rising slowly enough that most people will not notice until it is above their waist, and by then the time for preparation will have passed. Will you be the depositor holding a claim on a bank that cannot honor its promises, or will you be the person who holds what the world actually needs? China has already made its choice. It is buying 800 tons of gold per year and reducing its treasury holdings. Central banks across the globe have made their choice. They are hoarding hard assets at a pace not seen since the collapse of the Bretton Woods system. The billionaires have made their choice. They are quietly exiting the paper financial system and acquiring real, tangible, productive assets. The time for complacency is over. The time for action is right now. Share this video with everyone you care about, your family, your friends, anyone whose financial future matters to you. Subscribe to this channel and turn on notifications because we are not just creating content here. We are building a community of informed, prepared, and empowered individuals who refuse to be blindsided by a crisis that is hiding in plain sight. Together, we can navigate this and emerge with our wealth and our freedom intact. The information is here. The data is clear. The only question left is what you are going to do about it.